Stocktwits Nation, welcome to the Daily Rip Live. It is Monday, August 18th. I am back from a few days off here with Shay Boloor. Shay, thank you for holding down the fort. Did I miss anything exciting?
Dead week. Not much happened
Right.
except for the U.S. government becoming the new great hedge fund on becoming a part owner of what Intel, now MP Materials. Who knows what's next? Maybe quantum, maybe space.
Right. Yes, I missed that. I was actually pretty unplugged from the market news. I woke up this morning. I was trying to catch up, but seems like didn't miss too much. But there are some things ahead for the week we're going to get into. But before we get going, I want to take a second to let you know that today's episode is presented by Surf Air Mobility. Surf Air is transforming air mobility with AI-enabled software, electrified aircraft, and a nationwide flight network. As one of the largest U.S. regional commuter airlines, Surf Air is creating a platform to redefine the future of regional travel, and you can learn more at surfair.com. Shay, did you have a good weekend?
I did. You guys know I'm getting married in a couple weeks, so my friends did some festivities this past weekend. And yeah, I went to a Dodger game yesterday. We won eighth inning game-winning home run by Mookie, and it was against the Padres. So we're in first place. Big October-like game in September, and clearly, you guys see, I'm just fully red right now. My sunburn and stuff. But it was fun. I'm recovering, but it's fun.
That's a good end of summer activity. I caught some of the Bills preseason game versus the Bears where they got absolutely smoked, but doesn't count. I think it was like 38-0. Yeah, I hung out in New York a few days. I went to Connecticut a few days, and one of the days in New York, actually there's a Margaritaville Times Square, and there's a pool. And I got a day pass for the Margaritaville pool in time, which I'm not even going to gatekeep this, guys. It was awesome. It was so weird being in a pool in Times Square. Lots of Jimmy Buffett. But I digress. Let's talk about what we got going ahead for the week today. We got a major cybersecurity player reporting earnings. After the closing bell, it's Palo Alto Networks. And if you recall, in Q1, they grew revenue by about 14% year over year. They beat their expectations. They saw gains in cloud and subscription services. And so for this one, investors are really seeing if the company can keep up the strong growth. Shay, you've brought up these guys before in sort of your philosophy of, I know CrowdStrike's a big one for you, going with a winner, but Palo Alto being in the consideration set. Any expectations ahead of their earnings that are coming later today?
I actually have a position in Palo Alto for these earnings. I bought 2 weeks ago from this pullback they've gone from that CyberArk acquisition. The market clearly doesn't like the price tag on that. They believe it's an acquisition in defense, not offense. They think they're having to make this acquisition because they can't organically have the latest and greatest module. I think there's only so many players that are clear blue chip or tier one cybersecurity names out there. If you want exposure in that theme, the two names you go to is CrowdStrike and Palo Alto. Everyone else There's great niche products, great angles towards it, but the platformization of cybersecurity, there's really only two pure names like that. So I was like, oh man, under 170, too aggressive, too quick, especially when I'm bullish on the CyberArk acquisition because I think that yes, 25 billion is a lot. It's 10x what their previous record acquisition cost was. But this is clearly where the puck is heading in enterprise AI. And I think that Palo Alto is clearly positioning for that next wave where it actually looks like securing not just the users and passwords, but every AI agent, every machine credential, every autonomous workflow lives inside this enterprise stack. And CyberArk's whole thing is about the control layer. So I think that if you believe that AI is going to reshape how companies operate, spoiler alert, I obviously do, and that every agent, every API, every LLM query needs to be verified, secured, and audited, this acquisition makes sense for this platformization angle of what Palo Alto has been trying to communicate. And I think that it going on 25% in a matter of a couple of weeks, entering this print sets them up, have a low bar, over deliver. But who knows? I think this is a type of cycle where software has gone brutalized way more than expected due to a re-rating of specific buckets. I don't think cybersecurity is going to get re-rated from that AI tsunami because it's just one of those themes that have a massive tailwind that is offensive on AI and also defensive because it's a one-line item that CTOs don't cut as well. So I think that Palo Alto is positioned pretty well right now in the print. We'll see this afternoon. Maybe it's a 1% position for me, so it's pretty minimal. I think using cybersecurity comps, it's at a 22% discount towards their peers. And I just told you guys I think this is tier one. It should be above their peers. So I think it's going to be like a $200 plus stock. We'll see.
And the CyberArk acquisition, remind me, is that expanding kind of the modules of their platform? They can protect more aspects of an enterprise with that acquisition?
Yeah, so it's essentially selling exactly what you said. It's an additional module adoption where their whole thing again is privileges. So who governs the privileges of AI agents, these LLM outputs, like these, it's like an overlooked part of the cybersecurity ecosystem where identities right now are still humans logging in, for example, like with passwords, it's very tedious, but like the way things are going in the agentic AI world, it's going to be AI agents and it's going to be all these machine learning inputs where it's not going to be humans as much. It's going to drastically get lower and lower. So knowing that's where the puck's heading, you kind of need these privileges of these logins to monitor them. And I think that Palo Alto really probably doesn't have that specific layer in their AI stack. And I think that where every automated action has to be authenticated and all the system interaction needs to be logged and has to be query gated, all these LLMs in a policy-based control layer, you need like what CyberArk offers. It's like the hall monitor. Like nobody respects the hall monitor, but you kind of need someone there in place or things will go chaotic. Things can get slipped through the cracks and it can really blow up. Like this is the CyberArk's kind of the person that you kind of need that does a nitty gritty. That's just like nobody cares about, but you have to have that in place.
Oh my god, hall monitor is a throwback. I actually raised my hand to be a hall monitor in middle school, so that says really everything you need to know about me. It was once an ARC, always an ARC. No running in the halls. Let's look ahead to what else is going on this week. We got some major retailers set to report. Of course, that's going to give us a pulse check on the state of the consumer. Tomorrow, we kick off with Home Depot. In Q1, they had pretty strong results, 9.4% increase in sales. Earnings dipped a bit as they saw their profits slide. And on that call, the executives stressed that they did not plan to pass tariff costs on to customers. We will see sort of if that's the same story when they report Tuesday. Also reporting Tuesday, Home Depot's competitor Lowe's. So we'll get two pulse checks on home building, reno, all of the things that people invest in when they're not so worried about economic constraints. Wednesday, we have Target. So if you guys remember Q1, Target had a pretty rough quarter. Their revenue was down nearly 3%. Profits were down 36%. They are trying to obviously claw out of that spring slump. That will be one to watch as well on Wednesday. Thursday, Walmart, unlike Target, they had a decent Q1. They grew revenue and profits, saw some strengths in their online shopping. So they'll be looking to obviously sustain some of that momentum as they mitigate the impact of inflation and tariffs. So Tuesday, Wednesday, Thursday, we're going to get sort of a check on how people are spending, what they're spending on. And then Friday, it's the Jackson Hole Economic Symposium. That is where we were expecting to hear some more commentary from Chair Jay Powell. And one of the, he's only going to make a few remarks before this next FOMC meeting, which is, I believe, the 16th and 17th of September, where the markets are predicting a rate cut. So I looked on Polymarket. They 71% say a chance of 25 bips. CME Group has the odds at 85%. Shy, what would need to happen for them to not make a cut here? Like it's pretty much a foregone conclusion that that's going to happen.
I think last week's PPI was really worst case scenario, and the market shrugged it off because of the political will that's at play right now. Where whether or not Powell wants to admit it, rate cuts are coming. If Powell doesn't do it, I can promise you the next chair that follows suit is going to cut rates, because that is clearly a big rock on the Trump administration. So I think that the odds went lower on a September rate cuts after the hot PPI, but barely. Like it was minimal. Where if this was the kind of print we got 2 years ago, a year ago, it for sure kick the can down the road of like, we're not going to cut rates. But markets like essentially saying that's going to happen. I still believe, you guys heard me last week or a couple weeks ago talk about this, that it's going to be a sell the news event when the Fed actually cut rates. And I think that's kind of what's been holding up the market so well, knowing that something like that, a catalytic tailwind, is for sure coming, that there is a high floor in any kind of pullback. So it just, even if it kicks down the road, it might prolong this market rally before we actually get a real pullback. And I think that unfortunately, there is a lot of political will. I think the Fed has always tried to be as independent as possible, but this is a really interesting time where Powell's contract is up and we have a president who's very vocal about what he wants from that independence space, and I think he's going to get it. So we'll see. I will say the PPI, though, it's talking about retailers. I do think it's going to get passed on to consumers after seeing how hot of a print that was. So this week we'll get some commentary on the conference calls probably and see what their philosophy is. But I do think consumers will start feeling that in the near term.
Yeah, I agree. One thing I was checking in on last week, although I was trying to unplug a bit, was the slate of people who could potentially replace Powell. Some interesting characters there. I don't know if there's a favorite pick among like in FinTwit, Shire, your circles. Is there one people like more than the others, or are they just looking for change generally? This guy Zervos looks like a character. He stuck out to me in the lineup, just mostly based on the chin strap, because I don't think we've ever had a Fed chair with a chin strap. But what are the streets saying about this motley crew?
I mean, essentially it's tomato, because I think that whoever goes becomes, oh my God, that's him.
Yeah.
He looks like a Disney villain.
It's kind of perfect.
That would be kind of scary though. Can you imagine like just him answering those pressers?
Sure, he's a competent, qualified guy, but the facial hair, I don't know what it's giving. Like it's interesting. We're in strange times.
Yeah, Steven Seagal for sure.
Oh
just like Steven Seagal. I can't unsee that now.
What are we doing? Anyway, no shade to that man. I don't know much about him. I'm gonna do my homework and look into it, but we don't judge just based on facial hair on this show, but we judge a little. But okay, so you're saying, it doesn't really matter. Just new blood is what people are looking for, and they're gonna get it very soon. All right. Well, sticking on to what's going on in the political world as it impacts business, Ukrainian Prime Minister Vladimir Zelensky just arrived in DC late last night. This is following Trump's meeting with Putin in Alaska last week. This week's meeting follows on the other one, which I remember, I don't know, when was that? May or June? It got a little testy. Zelensky wasn't wearing a suit. That was an issue. But they're hoping to reach some sort of agreement for peace out there, which the talks could signal some progress in terms of ending the war in Ukraine. That's been obviously going on for quite some time. Uh, Oil stocks, looking at those, more Russian oil and gas could flow freely again if this conflict is resolved, which would increase global supply and push the prices down. But on the flip side, you never really know how these conversations are going to go. So we'll be watching. We'll be having our alerts on to see if there's anything tweeted out or shared out afterwards. But that is also going down this week. Those photos from Putin and Trump in Alaska were pretty, I would say, historical. I mean, I don't. He's not frequently on American soil. Correct me. I don't remember the last time he was. And there was some conflicting reports after that meeting. Did it go well? Did it not go well? But there was commentary after that they were aligned on finding a way to end the madness over there. So we'll see about that one as well. It's always the quiet weeks sometimes that get you, and I feel like something always gets posted while we're on air, Shy. So we'll have to keep an eye on that. Um, I did notice, Shy, shifting gears a bit. You shared out recently sort of an overview of some of your small cap positions. And I know most of your portfolio are these high conviction companies that are owning these specific thematics. But you want to tell us a little bit about your small cap players, who they are, why'd you pick them?
Yeah, so it's funny. My small cap portfolio has been outperforming my growth portfolio past 3 years, and I treat it as a church and states kind
Mhm.
of between my holdings because this portfolio specifically is clearly the risk curve is much higher than my growth portfolio, where I factor in a lot of fundamentals in my growth portfolio. This is more who has a disruptive tech, who will have early disruption and secular growth theme with plenty of runway. That's why I was able to find Rock Lab. My average cost base is at $6. Clearly, that's like the massive winner for me. And I think that I believed very early on that this is not just a launching company. It's like far greater than where the market's like kind of pricing them as, especially when there is only so many pure space names out there that you can get exposure in. And if this portfolio comes with a 5+ year outlook that's being baked in, that's kind of the only kind of mindset you should have in small cap investing is having a long-term mentality about something that they can maybe morph into. So do the research early on, build that conviction that you're willing to hold through that froth and fear, because volatility is absolutely the cost of admission when you're a small cap investor. And if you're going to be playing in this part of the market, you have to accept turbulence as that toll. So I think that for Rock Lab, like early on, it was just they're not a niche launching company. They're a vertically integrated platform with $1 billion plus backlog. They have growing Pentagon exposure. Everything that happened with Elon Musk just a couple months ago, fine. Maybe nothing initially will materialize, but the sentiment is shifting where you see how there is an agent of chaos a little on relying solely on an Elon company that you just can't afford to do so for a national security component, a component to it. So I think that now the US government maybe is more willing to test the next player in line, and that's Rocket Lab. So I think already you're seeing that Rocket Lab has doubled their launch revenue mix in just 1 year. They're kind of gaining more and more institutional trust, and that doesn't happen by accident. It happens when you stop being a space company and you actually start being a supplier of mission critical infrastructure. So I call them the space logistics company in the future. You see another name on that list was AST Space Mobile, and I think a lot of people scuffed at them because they're pre-revenue. It's really difficult to invest in a pre-revenue company. It's already extremely difficult to invest in a small cap company with revenue unprofitable, but no revenue, you're essentially believing a story. And I think that they've proven that the tech with live two-way video from space to unmodified smartphones works. So it's not just a science experience anymore. When is the revenue commercialization and scaling starts to happen? They've already locked in over 40 or 50 global telecom partners. They're now producing their second constellation with like a commercial service right that's going to be happening right around the corner. They're supposed to be making 60 to 70 million dollars second half this year. They're not a consumer hardware company. A lot of people confuse that they are because of Starlink. This is purely a B2B infrastructure player, and it's built to scale invisibly because they're just plugging into all these existing networks. They're charging carriers like AT&T, Verizon, as an add-on to whatever their existing structure is. So I think that they're becoming the American Tower of Space. Rocket Lab's becoming the FedEx of space, and they're being re-rated accordingly because you're seeing that the $2 trillion space economy that's happening in 15 years, like it's happening more quickly than anticipated. And there's only two players you should really trust in that space right here. Like you saw what happened in Redwire. That is red flag corporate governance. The rest are just such niche NASA plays that are in the publicly traded markets. Like there's only two, and that's why they're both like 15 and $20 billion already. Next one is JMIA. A lot of people have written this off, and I get it. It's like this is one of my most stubborn holdings I've had the past couple years. Everyone calls them the Amazon of Africa, and they blew up to like $60 or $70 during the COVID bubble. Came all crashing down under $2. Then a year ago, they had a new CEO, or a couple years ago, the new CEO that was like really trimming the fat, focusing on the high growth levers of their business, and it looked like the turnaround is very real. And they were being priced with a solvency risk under $2, and now that cash burn reduction, that there's a pathway that towards break-even profitability looked like a reality potentially. Gave people hope, went back to $12, and then all of a sudden they reported their earnings, did a secondary offer. It was just like that was a yellow flag what the corporate governance did. I think it was a year ago actually, or a year and a half ago. And I was like, wow, you're going to do that after what you did in COVID bubble? That is alarming. So for me, I was almost going to cut that position when it was at $4 after what they did. But then it's just they have such such a massive moat in what they do in Africa. I think people confuse them a lot for just an e-commerce company. But the reason I'm bullish on them isn't just because of their e-commerce business. Yes, that helps, but you're seeing a lot of these Chinese e-commerce companies can go into that space and essentially underprice everything that Jumia is doing on that platform. But Jumia is mainly about logistics. Like a lot of people don't realize it's a wild west there where they actually don't have addresses. Like Jumia has this like massive presence on the ground that cannot be replicated. Doesn't matter how much money you throw in that space, in that area. They just don't have the infrastructure that you can actually flip a switch and like you'll be legs on the ground on the infrastructure. If you're an Amazon, a Pinduoduo, etc., Alibaba, you just can't. So you need to partner up with them for the logistics because Jumia already has that presence there. That's a massive moat. So the whole thing about Jumia has always been solvency risk. Like, are they going to be able to like make it out of this and then they let the TAM high tide resolve boats and have the TAM expansion be for Jumia? And I think that everyone knows that Africa is the highest CAGR among e-commerce for the next like decade plus. It's a massive opportunity. Everyone wants a piece of Africa if you're an e-commerce player. It's just such a headache and so difficult to do so. But if Jumia becomes like that player, I think they are going to go through a massive re-rating. And their last earnings report was an inflection point, in my opinion, where things are changing. You finally saw proof of that because for 2 years, the story has always been about promises, like I mentioned. They're going to cut costs. They're going to scale responsibly to reach break even without having to raise capital. They diluted a year ago, broke a lot of trust because they said they wouldn't do so, and they did. But this time, like this recent print, like numbers actually backed it up. The revenue was growing 25%. Their GMV accelerated again this summer. Guidance was raised across the board. I don't remember the last time they actually did that. They reaffirmed that they're going to hit break even next year and they're going to be profitable by 2027. with no additional capital needed. So I think that alone reframes their entire risk profile of the stock, where servicing risk is removed. If management pulls their whole shenanigans like they did last year, that's it. I'm done with the stock. I think a lot of people would be done because you can't trust me. You just saw what happened to Redwire. Like I'm a little more flexible than I want to care to admit to Jumia's management last
I was
year,
just
but
say you're like it's like an X, you taking them back, but Redwire, you're it's like
well,
what
Jumia.
determines? But you see all the proof was in the results. You're like, okay.
So I think for Jumia, it was like they were seeing a lot of interviews and calls that they don't need additional capital, like months before their actual reports. Redwire legit went on TV hours before their awful earnings report, pumping their stock. That's insanity for me. Where for Jumia, it was like they didn't need they didn't need capital. They said it for the past couple of months, but like they didn't do it the week of their earnings report, then rug pull everyone. So I think there's a slight difference on that. But for the Jumia tone, like if you heard the conference call, you can really sense the confidence is finally like replacing caution for them in a way where Nigeria is their bread and butter. Like that is where it's going to make it or break it for Jumia's risk profile, because it's underpenetrated. It's their highest profitable area. GMV went up 36% alone in that area, and it looks like it's going to become that engine for this whole company. So their customer acquisition is clearly working if the GMV goes up 36%. And I think that they also made some commentary that the repeat rates are climbing and the paid marketing is being reintroduced slowly and profitably. There is a pay ads component now to them. And I think like unlike prior quarters, like there was no reliance on any kind of one-time benefits or financial engineering like cash burn, excluding all the working capital, was like in the low single digits. Like it was like $6 or $7 or $8 million. So I do think that they're doing all the things necessary to see things are working. And Jumia delivery is like going to be that fulfillment efficiency that they're going to offer to all these partners. And I think you're going to see like a momentum change in the stock. And you saw if you pull up the Jumia charts, Keith, like it is, you sense there's an inflection period, that change that happened recently on usually a bump on the stock on an earnings report. It's been faded like past 2 years. But you see, like right now, like look at those look at this move. Like past 6 months, it's tripled. But like you see those candles recently. There's someone accumulating the stock because there's something that's getting re-rated in a less than $1 billion company in a region like Africa, that they're the only presence there on the logistics fronts. That's a massive like valuation you should put on that just alone. On if they're not going to die off and they're like the logistics engine of the whole Africa region, what price tag would you put on that? It's a high one. And if they're actually going to be profitable within the next 18 months, different game, totally different game. So I think that this is going to be a very attractive asset for someone to acquire if they want to go the acquisition route. But I think it justifies a re-rating. I actually do think this is going to be like a $15+ stock very quickly. And I think that this is one of those names where like I've been building it up out of a leap of faith and my trust of myself that I think they'll figure it out because they have such an incredible presence and moats. And if they freaking rug pull us again, like I hope they don't, but I really think this is going to be a massive player. And it's a top 3 position for me all of a sudden. It's higher than Ion. It's higher than IonQ. It's higher than ASTS. Like it's just it grew into a big position.
Well, it said a couple things that were interesting. One, just I didn't realize they could plug as a logistics layer into other e-commerce. I think that's interesting. And you did bring up the marketing aspect, and I think that's something to call out, especially as we hear from Target and Walmart. Retail media is sort of this not new, but new historically versus the past. But that's, of course, the ads you see when you're on these e-commerce platforms, be it Amazon, Walmart, Target. A lot of money from advertisers is flowing into making sure that you're getting that premium real estate on the page. And it sounds like Jumia has that component as well. So that's another thing to watch and think about as you think about these companies. They also make money on the brand's advertising. So they get a cut of the sales, but they also get a cut of the paid placement to when things are suggested to you. So JMIA has that component. There we are with the opening bell. Walmart does. I believe that was a growing segment of their
Well,
business. Yeah, go ahead, Ty.
Amazon, 25% of their retail revenue is from ads
Yeah.
now. Like, I think that's why it's so difficult for me. That's why I dumped Trade Desk a couple months ago. I was just like,
Mhm.
I just don't know what kind of premium you can put on a pure ad tech name when there's so many companies just getting a more and more ad revenue in their controlled
Yeah.
environment and ecosystem. Like, that's enough for me then to risk the biscuit on the go-to player outside the wall gardens. Like, what value do you put on that? It's difficult. And I think that's why you're seeing them get re-rated so aggressively, because maybe they don't deserve a premium. And
Yeah.
that's what's happening to the stock.
Yeah, that was did they report last week? I think I caught a headline. They were down significantly, I think.
I think it was 2 weeks ago
Okay.
they
Wow.
reported.
Okay. 2 weeks
But
ago. But
it was
yeah,
ugly.
so
Oh,
you're
and
probably
Jumia
pretty
is catching a bid now. It's above $8 now. It's up 5%.
all right.
It continues.
And when you said Jumia is your biggest position, you meant in the small cap portfolio.
Yeah,
Okay.
it's my third biggest position or in my small
Oh,
cap
wow.
portfolio. And yeah, I just think right now in the market, it's the winners have proven why they should be winning, and they've gone through pretty aggressive multiple expansions. Like for Rocket Lab at $45, I love them, but they were at $5 a year and a half ago. They went through a multiple expansion. ASTS, same thing. Robinhood, Palantir, Cloudflare, etc. All these names, the market has rewarded them because they've proven why they should be the winner of the new digital economy. So now, if I have capital coming in every month, where do I allocate it? Am I just going to let it sit and chill on the sidelines until the market has some black swan event? No, like I want it to work for me. I don't want it to. I want my cash finding unemployments, essentially. I want them to be working, grinding, finding next opportunity. And they're the ones, there is a slight disconnect on what it's been. And I think they're going to change the narrative. Like the Jumia's out there. Digital Ocean's another one. There's a rare amount of names like that where markets already indicate they're not going to be a winner, and they've shown last two earnings reports they're actually pivoting. I'm getting ahead of it. There's risk associated because clearly I can be the schmuck of like believing something that's changed and it hasn't changed. But there's not that many opportunities out there right now. It's tough. It's tough to find winners.
Yeah, I mean, especially in small caps, there's a lot to sift through. And gang in the chat, if you guys have any small cap players you want us to look into, drop those down below. Markets ticking slightly lower. Bitcoin dipping below 115K. It was at about 124K late last week. I spotted an interesting headline in a crypto publication this morning about uh, BlackRock. So BlackRock disclosed a 5% stake in Strategy. Of course, that's Michael Saylor's a company. They're buying up a lot of Bitcoin. They have more Bitcoin than many countries. And there's some chatter in the crypto community on both sides. I think there's some criticism that people believe BlackRock owning too much of a stake in some of these crypto-centric players, and of course, they have their Bitcoin, their crypto ETFs. People worry that could sort of mess with the independence of crypto and the promise of that. Of course, that's also sort of that stamp of approval that we've talked about on the show with more and more institutions getting in to crypto. But that's where we're at with the state of Bitcoin. If you guys didn't check out my chat with Mike Novogratz from Galaxy Digital, and it's on the YouTube page. Really interesting guy. It was a pretty entertaining 15-minute interview. But he goes into sort of their strategies there. They're building data centers, but they also obviously are investing heavily in this space. So a lot's going on that end as well. Shy, any thought? I know crypto, you're not super focused there, but there are like it's blurring lines now between the traditional finance and decentralized finance. Any thoughts on like some of these companies that are building, they're in the public markets currently, but they're building adjacent or directly within crypto? Do you think that could potentially be a theme that could emerge for you in the future of what are the companies sort of powering that future?
Yeah, I mean, I think crypto miners are a really interesting angle I'm like looking into more after earnings season because it's like not crypto's not the reason why I'm bullish on them or looking into them. It's I think that they have a lot of infrastructure that might be needed as power experiences a constraints from AI. Like these AI compute workloads are only increasing. The velocity is pretty insane. I think it's a lot higher than a lot of even the most bullish AI anticipated. And I think that you're going to have to leverage places that have cheap power, massive facilities, and racks of GPUs. What these miners used to capitalize on were clearly crypto, and that's why they built up for that. But why it doesn't have to just be for crypto. They can easily make a pivot towards AI computes. And like I mentioned just now, like power, not coins, is like the true currency going forward. I think they can capitalize on that pretty efficiently once we hit our head against the wall on guys, the grid can't handle anymore. Like, yeah, the demand is so high. We need to find alternative solutions to fulfill it. And that's power. Where can we go in the immediate? These miners might be the immediate. So there's names that I'm watching that space. But yeah, I mean, what Tom Lee's doing with that Ethereum treasury, it's incredible to see. And I think that it's one of those like themes that Peter Thiel's backing, Kathy Wood's backing. Like a lot of bright people are backing the strategy market micro strategy routes, and we'll see where it ends up. Clearly, things are happening so quickly. So and in the past, when things happen this quickly and this aggressively, this amount of money, something wonky can occur where they overdid it, over leveraged themselves. Maybe this is I don't know. I'm learning into it. I don't want to talk too much about it, but it's the strength that crypto's had the past 6 months is incredible and it's impossible to ignore.
Yeah, I mean, your point even about the crypto, the miners turning into AI. I interviewed, I think it was like a year ago. I think it was the CFO of Applied Digital, and that was one of those companies that they started like hardcore crypto mining, and then to your point, that's the infrastructure that also enables this other thing that there's a lot of demand for. So, I think that's a really interesting call out because obviously they would stand to benefit with the growth of and sustained momentum of crypto, but obviously AI demand continues to be top of mind. And you mentioned Tom Lee. I believe the producer can correct me if I'm wrong. I believe he will be at Stocktoberfest.
Mhm.
So check that out, guys. We'll be there. He'll be there. All right, this is the plan. That's not to be confirmed, but the streets are saying. But some also Jake Woo's going to be there, some other familiar faces, so you guys can check that out on the Stocktwits website. I did just see I love an atrocious rebrand, Shy, and I just saw a headline that MSNBC is fully rebranding, and this is in my marketing expertise one of the most egregious awful
Wait,
rebrands I've
what's
ever
what's the,
seen.
what's the rebrand? I didn't know about
So
this.
they are rebranding. I'm gonna pull this up. I just tweeted it. It was so bad. It's called like MS Now. Um, Let me pull this up. I
Wait, so
don't.
they're removing NBC?
Yes. So obviously, media is a tough business to be in, and they've been struggling. I think they're on like they've gotten rid of a lot of talent. They're replacing people. Uh, they someone just responded, "We here for you." Uh, was that from Succession? I'm gonna pull this up because it's just not. So yeah, MS Now, no MSNBC. They're losing the Peacock. They're trying to kind of divorce from NBC completely, but the logo has like an American flag with two stripes, and then below it, oh yeah, my source, News Opinion World.
So it's so dumb. It's just like
It's
HBO Max dropping HBO to just be like Max. It doesn't make
it
sense to
is
me.
the worst. I have so many things. First of all, and then we'll get back to financial markets brief moment. The font at the bottom is the most overused font I would say of the last year. This is sort of like this like Cheerios font that everyone is using. And yes, as our producer notes, it's giving a little Newsmax. They're clearly trying to break away from what people have known them for. And CNN had a similar transition. A lot of people saying they moved slightly center. Um, Media is a tough business because it's supposed to be journalism, supposed to be unbiased, but of course you have this O word opinion that is baked in. So in order to, Fox is the most successful by ad revenue and viewership. And that's because they've just sort of owned the right. And if you build a product for an audience, you'll get the advertiser dollars, you'll get the viewers. But it's tough if you want to, you can't play both sides because then you piss people off on one side, you lose viewership. But MSNBC obviously thinking they need to make a change, and that's parent company's Comcast. I don't know what's going on with this. I don't know how much they paid for it. I don't know what you guys think in the chat. It's I don't know what this is. They might to your point, Shy, have an HBO Max moment where they just go back.
Well, it has to. I just don't understand the concept of removing the NBC part. That's such a. It's hard to build brand awareness to the extent
Yeah.
of everyone knowing NBC. It's just like why? Like it does not make sense. Maybe there's something weird at play where they just had to pay up to include NBC. I don't know, but I think
Yeah.
that it's not a good move.
Yeah, I suspect it's to like get away from NBC's reputation of being more left leaning. But NBC News also carries like a brand cachet historically of being one of the, top news outlets in the country. So I don't know. I don't know why people do this. A lot of people approved of that. I'm not a fan. If anyone's a fan, let me know. We'll see if they retain that or not. Speaking of companies with bad rebrands, in my opinion, I caught this article in the Wall Street Journal about how restaurants like Olive Garden, which a few years ago had a rebrand that was bad, I think. But they're calling it the Chili's economy. And uh, it's really interesting. But basically, what's happening is, we saw earnings from Kava, Sweetgreen. A lot of those companies are struggling right now. And I think it's because the cost of food for takeaway for QSR is like not that different now than if you went and sat down at a Chili's or an Applebee's. And so those types of places, per this Wall Street Journal report, are actually doing quite well. Your Olive Gardens. So Chili's posted a 24% jump in same store sales. It's a lot of fajitas. Olive Garden also doing quite well. I'm sure I have a personal involvement in that. I love Olive Garden, as I talk about on the show often. Cheesecake Factory also gaining ground. So it's all about this value gap. I mean, if you're going to pay $20 for a sweet green salad, you might as well pay 25 for one of those fajitas that comes out on the steaming tray. I don't know. Do you have a favorite among these, Shy?
I mean, my fiance hates this about me, but I enjoy Chili's. I don't know.
Chili's is
It's
great.
like it's got nostalgia for me. I do like the fajitas, but I think to go off your point on like why these restaurants and the Chipotle's, Cavas, etc. aren't, they don't offer experiences. The
Yeah.
Chipotle's, Cavas, like when you're a family of 4 or 5, like this is middle America type of thing. Like, do you go to Chipotle and that's your night out as a family? No, you
Yeah.
go to like a restaurant, like you mentioned, like it's a 15 to 20% premium on going to a restaurant to get that environment, the vibe of it, and like having a family outing versus just eating a burrito in a very cold environment that isn't warming. I'm getting served by a waiter, etc. So like,
Yeah.
I think it
And it's
makes
it's not
sense.
cheap anymore either.
Yeah, it's not. That's like, it's really not. It's like I think they're in a difficult place. Like the Kavas and especially Kava because like
Yeah.
they've been growing so aggressively, and v- I spent $50 on two bowls there and like two
Yeah.
drinks. Like that's not cheap at all. It's for a
No.
fast dining.
Yeah, it's interesting just being I mean, you're in LA, I'm in New York. That's a place where there's a lot of Sweet Greens and Kava. So when I saw Sweet Green had a sort of disappointing earnings, I was like, oh, is Kava, getting in there? And then Kava also not so great. I think Sweet Green, a lot of people are pissed because they're making the salads are getting smaller, I will say. Uh but Kava also. And obviously they're sourcing fresh produce for their stuff. There's a lot more cost pressures there. So I thought this was pretty interesting. But I think you're right. It's like people are looking for the little luxuries right now. So you might as well just
Mhm.
spend the extra $5 and get your fajita. But something to watch as well on that front. Shy, I want to go back to something a little more technical, but you recently posted about uh the Fibonacci. Is it Fibonacci or Fibonacci? Fib.
Fib, yeah.
Fibonacci levels. And you posted sort of an explainer about those. I think it might be good for people who aren't like as deep in this. Talk about what these price zones mean, and also sort of the rundown of companies you shared and what the implications of those are. And I'll drop the link of what you posted in for our producer to pull up. But you had companies like NVIDIA, others on the list, Rocket Lab. What is this metric? How do you use it? And yeah, what was this post all about?
Yeah, so Fib levels are a very useful tools to try to map psychology into price. And what I mean by that is you'd be surprised how often how much of a weight psychology is in an investor trying to get into a stock or not. It's not as binary as you think, oh, hit this 200 moving average, I'm gonna get it. Or like they put a if it goes to $50, I'll buy at $50. Like, even though there's nothing to back it up at $50. Like for Nvidia, everyone probably wants like as soon as it goes on $100, I'm going to buy it. It's just because they want to get that price point, psych level 100, etc. So I think for fib levels though, this is proven like these are retracement levels that give traders like some kind of framework to spot where those pauses and reverses tend to happen historically. Like for me, this list was primarily for the 0.382 ones. So these are often decision points where momentum either reloads or breaks down completely. So it's these fib levels are less about math magic or like technical reasons on why they're going to hit these levels. It's more about the market giving a common language for what supply, demand, investor behavior comes into one thing. So I think that's these are the levels I do it every week or every 2 weeks. I update them because they do change based on historical information. And these are the levels for the more recent retracement levels. So like if we get some kind of black swan events or any kind of pullback in the market, I go to this list and say, okay, so these are the retracement levels that market's saying psychology wise, they're probably going to head towards. And it'd be surprised how effective it is, like how efficient these levels have been. So I like to use this. I like to use 200 moving averages, but it gives me like a tool in my decision making. It's not end all be all, but I mean, Palantir at 129. It's also really funny if you like the comments, you see that people like, no way that's gonna happen. No way that's gonna happen. I've been doing this like posts for like years, guys. Like it's freaking happens. And it's a lot more aggressive. Like you should have seen when I did this post in February this year. People are like, there's no world Nvidia is gonna be below 130. It goes lower. It goes way lower. Like same with AMD. Like no way AMD is gonna get 100. It was at $85. Like it happens. Like
Yeah.
it's I'm sorry, but it does. So I think it's really important to have these levels in place. And when you have a substantial cash position, like for me, it's over 12, 15%. I have a conviction list of names I want exposure in that when we get that Black Swan event, I want these winners on my payroll essentially to work for me going forward because the bull market is inning 3 of a full baseball game bull market. Like we're gonna get some pullbacks, but I'm confident that AI is the main event for years and years to come. So that's gonna cause a high floor in any pullback. I have my names I want exposure. Like for I would love Tempest at $54. Rock Lab at $35. I probably wouldn't participate because you guys saw my number one position. Don't need to. But the names I want to build on are like what else? Nebius. I would love Nebius at $52. Like that's the level I'm watching. Aqua at $55 is interesting. I can't believe Robin is at $80 for that one, but you could have gone at $45 just a couple months ago. Like, so these are that's the way I'm thinking about the fit levels. Hopefully I answered
Yeah,
your
super
question on it.
helpful. Yeah, and like looking at that first name on the list, NVIDIA is reporting earnings on the 27th. So Not too long from now, we'll hear from them. Of course, that is the big one people are looking for. In New York, there's been earnings watch parties at pubs on Wall Street, which is really a sign of the times. But we will hear from those guys in a bit. You also mentioned Robinhood. We've been following some of these neo brokerages that have gone public. You have eToro now. You have Webull. That's Bull. Futu, I should say, FUTU, is a Chinese neo brokerage. They're reporting also this week. So another one to watch out for as we all see the trends in retail investing picking up steam. Other than that, we got some earnings coming up this week. We're watching, as we mentioned at the top of the show, Jackson Hole coming later this week, and some big AI earnings, as we mentioned later on in the next week. Shy, thoughts on what do you think is going to happen? I guess predictions for these retail stocks. I know you don't focus there, but do you think we've been talking on this show about not I don't want to say this will be the black swan, but something maybe not going so well in August. And that the potential for that happening, do you think that these retail sales could be could show slowed growth and tariff pressures?
I would not want to have any consumer exposed positions because consumers clearly have had an elastic behavior the past couple years where I thought they would break. I think a lot of smarter people than myself had thought that they would have to like break from the credit card expense fees, the debt, etc. That has not been the case. Like the demand has still been there. But at a certain point, I think the PPI running that hot and that second leg of having to raise prices on top of what happened a couple years ago
Mhm.
might be the straw that broke the camel's back. I think that the PPI being that much of a hot print above expectations, it's going to get passed to the retail. Like I think businesses have been taking that hit in this tariff wars. I think that now we're going to start seeing it pass to consumers, and we'll see from there. I mean, I Warren Buffett went hard on home builders in
Mm,
their recent quarter on what they added. So like maybe there's something he's seeing at play. I know real estate for me, like I'm looking to buy a house and just it's getting better for sure. Like
yeah.
there used to be a couple houses in my range of the area I wanted. Now there's dozens.
Mm,
So price it's more of the inventory is getting better. The price is still not where I think it should be. Some areas are going down 5% on their cutting their costs, but I think that maybe there's a play here that rate cuts are coming, whether anyone wants to admit it, and housing will pick back up. And that's why maybe the Home Depots out there will do well and the Lowe's out there. But like the Targets, like I don't know. Target is
Target's got some stuff to figure out. That's the one I think I'm watching this week, just because that was such a night and day from Walmart with
what
those guys.
they have no place in the world. Like if you think about it, like they just like they aren't nice. It's not a nice place. They don't have the
Yeah,
pricing that Costco and Walmart has. They don't have the environment that you would want. If you don't have the cheapest products, you want like some kind of
yeah,
ambiance or like some kind of offering. Like they're in the middle ground of like they don't offer the cheapest solutions and they don't really have any kind of offering that you can't get at a Best Buy or some other
yeah,
random retail store. So like they butchered becoming doubling down on logistics. They should have done what create some kind of subscription premium on like free deliveries, like early like they should not have gone in the grocery space, for example. I'm like, I would never buy groceries from Target. It doesn't make sense for me. Like it's I used to go there for middle school clothes. Maybe emphasize more on the retail clothing stuff. It's just they're doing too much and there isn't that much of a consumer offering on their pricing. I'm like, you just don't belong really. It doesn't make sense. But they're trading at 11 times earnings, so maybe they got penalized enough where if there's any kind of surprise on the upside in their prints, like they'll catch a bid.
yeah. It's almost if you've been at like Walmart through the years, they've moved closer to Target in terms of the experience in the store, the products, even where they're setting up Walmarts these days. In the suburbs, they used to be more in rural areas, so they're sort of inching that way. And then on the other side, Target. there seems to be a perception of diminished quality. But their prices are still higher uh, compared to a Walmart. So yeah, I'm interested to see what comes of that. I think a lot of people have eyes on Target. But other than that, we also have a big week here at Stocktwits. We're kicking off our Treasuries Unchained show. So we're heading to the New York Stock Exchange later today. This is, of course, going to be our new series on Bitcoin and crypto treasury strategies. So you'll see us from the desk there and look out for that content. But other than that, I think, markets aren't moving much so far as we get into the day. But we'll keep watching these headlines for you guys. And tomorrow we can talk all about Palo Alto. I think that'll be a good one. But other than that, thanks everyone for tuning in. Thanks again, Shy, for holding down the fort while I was resting. And we'll see everyone back here tomorrow morning, 9 a.m. Eastern on the Daily Rip Live.